If we start to slow materially in our economy, will you stop tightening even if inflation is still above your target?
Hey guys, Mike here. So obviously that is the big question. That is what has a lot of people worried, that if they start the tightening and then things slow down, will they continue to tighten like they've done in the past until they run us into a recession, right? And so finally today, at least he broached the subject of demand for the first time multiple times, because I don't think people realize the reason why they're going to be tightening is they're trying to slow demand down because the economy is super hot right now with all the stimulus they put out there.
Our goal is to get demand, use our tools to get demand and supply back in sync so that inflation moves down, and do so without a slowdown that amounts to a recession. That's our goal. We of course can't affect supply side issues. We really can't affect much food and energy prices either in the near term. So it comes down to what we can do is our tools work on demand. But we have a job to do on demand.
And so that's what we're talking about, right? Demand is up here, right? Supply is down here because of all the supply chain issues, which will definitely not stop, because obviously we hadn't even felt what's going on in Shanghai right now. You know, with all the boats sitting out there waiting to actually offload and onload product. We hadn't even felt that yet. But they're just trying to get demand down, supply up, so it meets somewhere in the middle here. Okay, that's the big thing. And I think what really spooked markets today, which they were already kind of selling off, but this one right here is something I've been thinking about for a while. And he goes into, you know, basically she asked him, you know, there's 350 basis points already baked in. That's what people are expecting. And so, you know, is that going to happen? He dodges the question basically and says, I'm not going to say what I'm going to do, but other, you know, Fed officials have said yes. And so here's what he had to say about that. And I think this did spook the markets a little bit.
I think if you look at, for example, if you look at the last tightening cycle, which was a 2-year string of 25 basis point hikes from 2004 to 2006, inflation was a little over 3%. So inflation is much higher now, and our policy rate is still more accommodative than it was then. So it is appropriate, in my view, to be moving a little more quickly. And I also think there's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So that does point, yes. That points in the direction of 50 basis points being on the table. Certainly, we make these decisions at the meeting, and we'll make them meeting by meeting, but I would say that 50 basis points will be on the table for the May meeting.
And I'll actually give you something else to think about. Let's go back to 2018, right? We'd already done 6 rate hikes coming in 2018, and they decided to run the balance sheet off. And let's compare where we're at then, where we're at now. Remember, same folks in charge pretty much across the board, okay? They all seem to be working for the Fed for their whole life, okay? So same crew, and you're looking at 2018 unemployment rate, 4.3%. Unemployment right now, 3.6%, and supposedly, as he said, there's 12 million jobs and only 6 million people to fill it, and we're going to get to that in just a minute, as you'll hear him talk about a lot about unemployment stuff and the labor force. Inflation sitting at 2.1% in 2018, 8.7, 6.5% and core inflation. Okay, if you back out all the other stuff you can't control, right? So about 3 times as much. Then Fed balance sheet, 4.5 trillion in 2018, 9 trillion 2022. Then we look at just and how much liquidity's flooded the market. Nothing really going on in 2018. Here we know what they've done, which he talked about in this interview as well. And so, if they're going to sit there and run off the balance sheet in 2018 and raise rates 4 more times after already doing 6 rate hikes, why in the world wouldn't they start doing that now? Continue to do it. That's what when you just look at it in that simple context, right? And obviously he references way back in the early 2000s when they were trying to cool off the real estate market, which of course, what do you see going on now? The real estate market is on fire, right? Especially in a lot of areas. They're going up dramatic, which I'm going to show you that as well. And why increase in these rates for mortgages is actually somewhat of a good thing, or what he wants to see happen. And that's what they mean when they say the market working for them. The bond market is also working for them. The stock market is not right now. And so, and of course that leads us into the big question of the day, right?
Do you need the stock market to be lower to impact demand?
I never would point to one particular price or asset or class of assets, but generally the way our policy works is we control one overnight rate, plus the balance sheet also has some effects. And that affects broader financial conditions, and that includes asset prices, include credit availability, risk spreads, all kinds of financial conditions. And the financial conditions in the end, those are what affect the real economy. So we monitor financial conditions. So there really are two steps there. And one of the many, there are many different combinations that are possible of financial conditions, and we have seen some tightening from our rate increases, and that's to be expected.
And this is what he's talking about when he's talking about certain things working in the right direction and tightening. This is mortgage rates. We just finally hit a point on the 30-year fixed mortgage, which is the most popular one people take out to buy a home. Going all the way back to 2009 is the last time we hit this level. And that's actually a good thing as far as slowing demand, which they're trying to do. Unfortunately, there's a big difference from what's happening now versus back then. Because if you look right here, the problem is supply, right? I mean, look at existing home inventories in 2009 when we had that rate right there. Look how high it is. And look what's happened ever since. It's just absolutely fell off a cliff, and that's where we're at now. And so, that's the big problem is there's not enough homes, and they can't be built fast enough, especially with all the input costs being up and all the shortages out there right now. And of course, if you look at this right here, this is home prices. What's happening? This is percentage, by the way, year-over-year change in home prices by percentage. Look at that right there. I mean, if that was a stock, you'd be a happy camper, wouldn't you? I mean, just going up dramatically. And Fannie Mae has even come out just recently where this chart came from and said it ain't going to stop anytime soon. By December, the end of this year, they still expect an 11.2% jump in home prices. We're not going to see any kind of relief until 2023 for those actually looking for a home, or if you're looking for an investment property or something. And I can verify this, and this is not all areas, right? Certain areas don't see this, but certain areas like Florida, for example, oh yes, we have seen price increases like you wouldn't believe. I mean, there are homes that people bought for $250,000 about 5 years ago. They've already doubled in value now, and they just doubled in value over the last 12 months. All right, not that 5-year period. They barely even moved. But now, all of a sudden, the last year, there's homes on average in certain areas are appreciating $20,000 a month. And I'm talking about regular homes, 3-bedroom, 2-bath, regular places like this, right? That's unbelievable, right? $20,000 a month is like the average, okay? And so that's what he's talking about when he's saying this should work for us, because all of a sudden, people are priced out of the market because of not just the price, but because of the mortgage rates. And that should allow people who are building homes to start building those homes. Nobody's buying them. All of a sudden, inventory starts to build up. Okay. And so, the last one, which this one right here, I know I'm in the minority. It pisses me off when I hear him talk about this. He talked about the labor force a lot. And so I'll let you hear what he has to say. I'll see what you take from it, and I'll kind of give you my take.
In the middle of this is a labor market in the United States where people can get paid well. It's too hot. It's unsustainably hot, but notwithstanding it, it's a very, very good labor market for workers. And it's our job to get it into a better place where supply and demand are closer together.
And what I take from that is you're making too much money, okay? You people working on the factory floors, you people working at the levels where you're generating income, you're billing for stuff so the company can make money, you're making too much. All right, we got to flatten that out or lower it, one of the two. But God forbid you try to rein in the executive pay, okay? Now, I've been a manager before. I know what these make. I just talked to somebody the other day. They said 40 VPs in their company. 40. Who needs 40 vice presidents? Yet what they do? They laid off people at the bottom, the ones actually doing the work. I'm like, wait a minute. How much does one executive vice president make? They make a good living. What does somebody make at the bottom down there, right? So it's just amazing to me. And again, I'm not going to rant because I can go on a rant for like an hour about this because I've done the research on it. It's ridiculous. This report just came out yesterday. It said CEOs made 40% more last year. I'm like, good Lord. If you've never looked at what an executive, especially these insurance companies, the CEOs make and the CFOs and all that, it's publicly traded. No, you can look it up. It's unbelievable. I mean, it'll make your head spin, for God's sakes, how much money they bring in 1 year. I mean, Elon Musk, at least he's the founder of his company. I think they said he actually gets like $23 billion in compensation now. They hit their numbers for the first quarter. I mean, but at least he's a founder. If you're a founder of a company, that's fine. But if you're just some hired gun to come in, because I don't know if you've had the privilege like I have of working for a CEO for a company who ran in the ground. It's running good before he got there. He gets there, runs in the ground, and then it says, hey, by the way, instead of cutting the executives' pay, we're going to lay the people off the bottom that actually generate the income for the company. That kind of stuff, it drives me nuts, and I've seen it multiple times. I'm going to stop there because, again, I can go on for an hour. But anyway, that's what Jerome Powell had to say. Obviously, the market, maybe they're getting, who knows, will probably be up, 2 or 3% on the QQQ tomorrow. On the NASDAQ, SPY will probably be up 2% tomorrow. We've had 2 days of red. But, it's amazing to see, though, the Tesla reports great numbers. They crush it, absolutely crush it. Market starts off good, and boy, it go bad quick. And this is supposed to be the good earnings. Like first quarter, this is supposed to be the highlight of the year, right? Because everybody's expecting growth to start slowing, actually, from here on out, especially if they start raising the rates and run off the balance sheet, right? So that's amazing to see. But anyway, just want to bring that to you. Let me know what you think about what he had to say. And understand that's what they're trying to do. They're trying to slow demand to bring supply and demand back in balance, right? And they can't control the supply chains, but they can definitely control the demand. How do you do that? You take money out of the market, okay? And so it's going to affect, obviously middle class and, below a lot more than it does the people above, but we'll see how it goes. So expecting a lot more volatility. So hope you have a good one. I'll see you Sunday.